has had experience of about 18 years spread over both equity research and fund management. Our alpha manager for this week is Harsha Upadhyay of Kotak Mutual Fund. He personally manages the Kotak Opportunities Fund, which has given returns of about 82% since its inception, and the Kotak Select Focus Fund, which has provided 3 years of annualized returns of 15.5%. Let's start by asking you what you make of where we are in the markets. Many people believe that this is a correction that's going on with several up moves. What's your take on where we are?
Clearly, we are in an uptrend, that's for sure. In terms of valuations, I think probably after the recent up move, we are probably fairly valued in terms of overall broad market valuations. But obviously, there are sectoral and stock-specific opportunities where one can still make money going forward, and especially in a scenario where earnings growth is recovering in the market. I think next 2-3 years are going to be great for equity investments.
Harsha, let's talk about both of your funds individually, starting first with the Select Focus Fund, where you have, I think, 3 key investment themes. Auto, oil and gas, I think, are 2. Can you talk us through how you've sort of decided on those 3 key sectors that you're mostly invested in?
Yes, these 2 sectors are overweight in our fund for quite some time now. The idea here is we wanted to play cyclical recovery. At the same time, did not want to take balance sheet risk. So auto and cement were the 2 sectors which stood out in terms of the cyclicality, also in terms of the capacities that are already there on ground. And as and when you see some pickup in volume growth, which has already happened in the past couple of months, you will definitely see that operating leverage coming through. And if you look at the overall auto industry, both commercial vehicles as well as passenger vehicles, they have seen sluggish phase for almost 3 to 5 years now. Just to give a number, I mean, commercial vehicles at the top in 2009 were selling about 3.5 lakh units in the country, and today that number is somewhere around 2 lakh units. So clearly, even if you assume that we will go back to the earlier number, there is a big upside in terms of volumes that can happen. Similar is the case with passenger vehicles. I mean, the car volumes for the first time in last 20 years, successfully for 3 financial years, they actually showed the negative growth, and that is changing. That has clearly changed in the last few months, and we expect that trend to continue. With high operating leverage, auto companies will definitely stand to deliver above market earnings growth over the next 2-3 years.
And yet, Harsha, sorry to interrupt you, but in your top 10 holdings for that fund, even though auto, cement and oil and gas are your key 3 sectors that you're overweight on, your top auto holding was just one, which was Maruti. Otherwise, you've got a bunch of IT stocks, TechM, TCS, Infosys, a couple of financial stocks, ICICI Bank, HDFC Bank, and then you've got Ultratech, which sort of justifies your cement play, BPCL, which justifies your oil and gas play, Petronet LNG, which is an unusual one, and Bajaj Finance and SBI, which are some of the other financial holdings. How is it that you don't have anything more than one auto stock in the top 10?
Well, that's not the right way to look at the portfolio. Portfolio consists approximately 45 stocks. So if you look at the overall weight of the auto sector, it's about 15%. Although you find, let's say, a couple of more stocks in the top 10 which are from other sectors, those sectors may not be 15% weight in the index, 15% weight in the portfolio. For example, cement, although it has one stock in the top 10, the overall weight in the portfolio is about 8%. So I don't think by looking at just top 10, one can really see through what's the portfolio construction. We continue to believe that auto is going to deliver above average earnings growth, and that's the reason why we have kept an overweight. Maybe on a stock-specific basis, it may not be finding its place in the top 10 yet.
What are some of your other auto picks? The reason why I'm focusing so much on auto is, I think about twofold, that you've picked Maruti and maybe not Tata Motors, because many people do prefer that. If you're looking at the JLR play, that's a question I want to ask you. Whether you think that the auto business is at turnaround point, that's another question I want to ask you. And whether you're also investing in some of the allied auto component businesses as part of your overweight on auto is the third question. I wanted to combine all these 3 and put them to you.
Menka, we have diversified holdings across auto sector. We are present in Maruti. We have Tata Motors in the portfolio. We have Motherson Sumi, which is another auto ancillary play, both geographically diversified as well as in terms of segments that it caters to, it's diversified. We have Mahindra and Mahindra in the portfolio. We have Bosch, again an auto ancillary company in the portfolio. And also we have a couple of tire names which are ancillaries in that sense in our portfolio.
And you believe the auto business is at turnaround point?
Yes, I think that has already probably happened in some segments of the auto business. It may not have happened in domestic commercial vehicle industry, but definitely in two-wheelers and four-wheelers, we are already seeing some pickup in volumes. And I'm sure that going into the festival season, you'll see better numbers continuing, and that trend should continue for next couple of years.
In oil and gas, Petronet LNG is an interesting pick. Can you talk us through the investment strategy on that one?
Yes, we believe that a lot of negative reaction has happened because of the problems that the company has faced at the Kochi LNG terminal, which is not being utilized at all at this point of time. At the same time, the valuations are very fair, and we believe that the second jetty which has come through in Dahej is going to add to volumes, and there is a second phase of expansion as well which can add to further volumes, and all this will happen by end of December 16, and also hopefully the pipeline issue that is affecting the Kochi terminal will also get resolved by then. If that were to happen, financial year 17 will be a very big year for Petronet LNG with additional capacity as well as some of the current issues getting resolved, and the valuations are very fair, and in the past the company has given reasonable ROCs of 25% plus, and that trend should come back over the next 18 to 24 months, and that's been our investment call there.
Harsha, BPCL has been a great pick, for everyone who's picked that stock, the top performer of the year. Do you think it has the ability to run further ahead from here on?
Yes, if you look at the geopolitical tension and the unrest that has happened in the Middle East, which has continued for past several years, we have not really seen crude oil prices moving up. If you look at Indian oil and gas industry, there were two main concerns. One, the volatility of crude oil, which we completely are dependent on in terms of international purchases. And the second one is the under recovery compared to the market pricing. Clearly, the crude oil prices, despite several geopolitical tensions, have remained very benign. And our expectation is if there are no big supply side shocks, I think we should be heading towards a stable to lower kind of a trajectory in crude oil prices. And at the same time, for the last 18 to 20 months, we have seen under recovery getting reduced, at least on diesel. Petrol is deregulated now, but you have diesel wherein the monthly price increases are continuing for last several months, and we are almost coming to a situation where in the next couple of months this will get finally completely erased, and that's one of the biggest reforms that has happened in the oil and gas sector for the last 20 years. And even today, even with all this, the companies are quoting below book value in terms of valuation, so we continue to like the space.
Okay, one of the things that struck me amongst your IT stocks and I think both your funds amongst their top 10 holdings include Tech Mahindra, TCS and Infi. And Tech Mahindra, it seems to me, is a Harsha Upadhyay favorite.
Yes, we believe that Tech Mahindra is going to deliver probably higher than industry or at the top end of the industry kind of growth rates for the next 2 years. There has been some concern because the telecom side of their operations has taken a hit because BT has moved out of Tech Mahindra to a large extent. But we believe if you look at the current business trajectory and look at non-BT telecom revenues, those have been growing very handsomely, and we believe that they can deliver better than industry kind of revenue growth. And at the same time, the valuations are very reasonable. They are not even equivalent to the market multiples, and we believe there is a strong re-rating case there.
What do you make of pharma, Harsha? The sector as a whole, because no pharmaceutical stock features in the top 10 for either of the two funds that you directly manage. And so I'm just curious to know, I think you're also admittedly slightly underweight on pharma, though pharma has been a great opportunity and a great gainer over the last several months. So I'm just curious to know what your position on pharma is.
Recently, we have gone underweight on pharma. For better part of last year, we were running equal to overweight on pharma sector. And the recent underweight stance has been more to do with the relative opportunities that we see in the defensive space. For example, in the IT sector, where we believe the valuations are more reasonable and probably the re-rating chances are higher in IT sector. And that's the reason why we have taken out some profit from the pharma sector.
How do you view the mid-cap space? Because I'm looking at your opportunities fund. You've capped mid-cap participation in that at about 40%. Can you talk us through why, A, and B, really, I think mid-caps has been a story of hope and to some degree, reality sort of setting in this earnings season. So how do you look at the space? I know it's difficult to generalize across the space, but what do you like within the mid-cap family?
As you rightly said, it's very difficult to generalize the overall mid-cap space. And in the strategies that we manage here, we generally tend to pick a few winners from some of the sectors that we like, rather than looking at mid-caps as an entire segment as such. We have other funds in the product portfolio which completely look at mid-caps as an opportunity. So to that extent, I think going forward, we will focus on stock-specific opportunities. There has been one round of great re-rating that has happened, and the valuations have really come up compared to large caps over the last 1 year, since mid-cap segment has almost given double the returns of large cap space. And from here on, I think it's going to be even more, there needs to be even more focus in terms of the kind of stocks that we get into. And generally, we have liked businesses where we believe there is some amount of competitive advantage, and with some amount of tailwind in the economy, they should be able to become leaders in the next phase of growth. And at the same time, we don't like companies which have balance sheet stress or which have high leverage on the balance sheet, because in any kind of volatile market, such companies tend to have difficult times. So generally, we prefer companies which have diversified businesses and not concentrated kind of a portfolio, and at the same time have a decent balance sheet.
Some of your mid-cap holdings include Prestige, J&K Cements, KEC International. These are stocks that have done very well. What else do you like in the space, Harsha, if you're at liberty to share with us?
I think most of the names you have already taken. I mean, we have quite a few picks in cement space from the mid-cap segment. We believe cement, as I earlier was speaking, it's one of the early cycle plays in an economic recovery. We believe that some of the issues that were really affecting the overall volume growth in the or the demand in the cement sector are probably resolved. For example, if you look at the South market, Telangana Andhra issue was actually leading to some kind of a hold up in most of the infrastructure build there. I think with two new governments, there is going to be pickup in infrastructure activity there. The central government has anyways looked at housing as one big new area for thrust. Similarly, there is going to be renewed focus on overall infrastructure, including smart cities, etc. So I think cement as a space will likely see probably higher demand growth compared to last 3 years. And it's a space where the capacity relations today stand at around probably 72 to 75% kind of a number. And once it crosses, let's say 80 to 85%, I think there is going to be a phenomenal pricing power that will come into the sector. And that's likely to happen over the next 1.5 to 2 years somewhere. And that's a good space to be in, and we have got some mid-cap picks in that segment.
All right, Harsha, we want to talk to you about FMCG, a space that you're underweight on, and yet you like Britannia. It is a pick amongst most of your funds, but we're going to do that after this quick commercial break. Stay right there. We'll come back and talk to our Alpha Manager of the Day, Harsha Upadhyay. conversation with our Alpha Manager of the Week, Harsha Upadhyay of Kotak Mutual Fund. Harsha, what will it take for you to start looking at the FMCG sector with more interest, either in terms of macro data, consumption data, or maybe a decrease in valuation itself of some of these stocks because they're quite richly valued? And yet, I just do want to point out to our viewers that you seem to like Britannia because that is in both the funds that we're currently scrutinizing today. So talk us through those strategies.
Yes, I think rather than the growth trajectory, I think valuations are what we are focusing on. And in case the valuations become a little more reasonable, I think we will probably increase the weight there. And it would also depend on various other relative opportunities that may come by at that point of time. As far as the name that you mentioned, I think clearly as FMCG space, as I said, it's richly valued. We are focusing on companies where there is some amount of margin improvement, there is some amount of market share gain, or they should have some kind of a leadership position. And only in those particular names we do have presence. And the company that you mentioned fits that bill, where they're gaining market share consistently over the last few years, and the margin profile is also improving, and we believe that that trend is likely to continue.
Not a single telecom stock features in your top 10, Harsha? You find the sector not sort of appetizing at this point in time, not attractive at all?
Yes, that's true. In 2013 calendar year, we had overweight position on telecom, but before the spectrum auction, we sold out of telecom sector. And the main reason for that was when we bought our positions, the hypothesis was competition is probably lessening, and there is going to be pricing power in the industry. And that hypothesis, we had to relook at that, given the fact that the spectrum auction needed a lot of money to be invested in the sector once again, and also there is entry of a new player whose plans are unknown at this point of time. So overall, the competition still continues to be hazy. And we haven't really seen a clear trend in terms of pricing power. So with all these uncertainties, we have moved out of that sector.
I'm assuming, given your position on the banking and financial space, that you're not terribly surprised with the poor numbers that we've seen come in for several of the PSU banks. You were anticipating this, which is why you've been underweight on this sector, especially on some of the PSU banks ever since the elections, if I understand that correctly.
That's right. In the run-up to the elections, we were maintaining a small overweight on the sector, and after the elections rally, we have cut some weight in PSU banks, which has worked out well in the very short term. But looking at it from a more broader perspective, I think clearly there are two issues which are in front of PSU banking space. One is on the NPA side. The second one is on the capital requirement. I think the NPA issue is more or less uniform across PSU banking space, but the capital requirement and the ability to raise money is differentiated. For example, the bigger banks have the ability to raise money, or already they have raised the money. So that is the area where probably with a recovery in economic scenario, things will turn around gradually. But in those public sector banks where there is a need for fresh capital, I think it's going to take a much longer time, and that's the reason why we are out of that space.
Harsha, I'm curious, your opportunities fund, how do you sort of position yourself here onwards, for an end to this correction and the next big move up in these markets, whether it comes in the next quarter or the next 6 months or the next 1 year? Are you looking at, or are you contemplating at this point in time any sector rotation or stocks or areas that you think will be the ones to lead the markets higher the next time round?
I think clearly some of those changes have already happened in the last few months. The auto and cement sector weight increase is part of that. We expect that recovery to continue. It's not a 1 or 2 quarter phenomenon. We believe that that's going to continue for next 2-3 years. Oil and gas is another space where we believe, given the fact that under recovery in diesel is coming to an end and also global prices are benign, we expect that sector to re-rate. So these are some of the recent changes that have happened on a sectoral basis.
But then why not include industrials of any sort? Why not include capital goods? Many people are betting that a recovery, albeit far away, is definitely sort of bound to happen, if you believe in this economy picking up. So why is it, you have L&T, I know, in both your funds in the top 10, but that's almost a default stock for anybody investing in these markets. So I'm just curious to know how you'd look at industrials, capital goods, infrastructure companies.
I think there is time before we actually start seeing good earnings numbers on the capital goods side, and also more or less the up move that has happened in the recent past, where we also participated to some extent. Currently, we may not be present in that segment, has more or less discounted even financial year 16 and financial year 17 in some cases in terms of earnings growth numbers. So we don't find too much value at this point of time, but obviously if there is a correction or if there is any change in fundamentals, probably we'll look at that segment once again more actively.
Okay, so what is your longer term expectation, Harsha, of how this market will move? Are we in for a difficult end of the year, a difficult second half, given the global cues, given the fact that, we're yet to see key constructive action by the government on big policy measures? Are you now pinning your hopes to any kind of substantial gains only to next calendar year?
It's very difficult to say. Yes, markets are fairly valued at this point of time, but if there is liquidity flow and if that continues in the markets, I think markets can move up higher. But fundamentally, I think the base is very solid now, and earnings growth trajectory is improving. We are looking at about 17.5% kind of an earnings growth over the next 2 years. I think that itself can give you a reasonable upside in equities. Forget the re-rating part. The re-rating would happen if there is some more reforms or some more tailwind from the global markets. Any of those were to happen, I think there can be a re-rating. But even without that, equities can deliver a reasonable upside on a 2 to 3 year basis.
So when you say reasonable, you're talking in the range of what?
Assuming that the market continues to trade at current multiples, which are fair in our opinion, the earnings growth numbers should lead market growth. That we are looking at about 17.5% over the next 2 years.
Okay. Finally, will you leave us with maybe sectors that you don't want to invest in at all at this point in time? Look, absolutely a big no-no to you. I know some of the sectors we haven't discussed and you're underweight on include utilities, metals, etc. So sectors or stocks that you would stay far, far away from.
I think clearly metals and utilities space, we have remained underweight and will continue to remain that way. In utilities, usually these are regulated entities. In a cyclical recovery phase, the regulated entities don't really make more profits than the market growth. And also there have been some interventions in the past which have not been positive for the sector, the regulatory interventions. So overall we are negative on that space. Metals is another one where overall in the material space we prefer to place cement, which is a local commodity rather than global commodities, because there are too many moving parts in case of global commodities. So that's the reason why we are underweight on metals.
All right, Harsha, we appreciate you joining us. Thank you for those insights into how you're looking at the markets at this point in time.